Hello and welcome to a brand new show of Market Makers. The month of April has been a choppy, unpredictable and a volatile month for Indian markets. Of late, Indian markets have corrected despite decent macro and global setup. So what is injecting this degree of nervousness and why are markets not really responding to good news? How should one read into this leg of correction, and is there enough value available after the recent bout of correction? To discuss all that and much more, I have someone who is a practitioner of value investing, S Naren of ICICI Prudential AMC. Naren, fantastic to have you back and thank you for joining us. What's gone wrong?
I think one is that if markets have to go up every month without fail, then there won't be need for fund managers or even TV channels. So, we had a period of time where it was inevitable that by the end of the month, market would go up. So, I think we've had this bout of volatility starting March. It reflects that markets are no longer that cheap and investors have to invest for the long term. So, I don't think there's so much to worry about for an investor. Everyone knew that the market was fully valued for the short term. When reality strikes, I think there's a certain unhappiness. That's about it.
But markets are correcting when the global backdrop is stable and macros have only improved. Typically, market correction should also coincide with bad news. Currently, market correction is coinciding with good news.
Actually, what happens is value investing has worked. If you look at it, there were a lot of emerging markets which were very, very cheap. And it had been underperformers for years. Suddenly, they've woken up in the last 3 months. And if you see the returns in the Russian market or Brazil market or China market, they've been phenomenal. So, when value investors whoever had invested in these countries, they got very good returns. The number of momentum growth investors who seeing India has done so well. We were overweight, we made money. Now, why not take back some of the money to our other countries, which were dogs for years? So, I think it's basically a victory of value investing in other countries, which are responsible for the current correction.
So, December, when we interacted last, you were of the view that, look, value in this market is missing. Nifty is off by about 7-8% from the recent high. Individual stocks are down 15, 17, even 25%. Is value back on the table?
Value is back, but for moderate returns. See, I think we have had a phenomenal situation in the last 18 months. And I think the most interesting aspect you'll see is the year-on-year earnings growth estimate for the fourth quarter is close to 0. So you are in a situation where the Nifty has gone up 25%, mid-cap and small-cap indices have gone up more than 50%, and earnings haven't grown. So that means that you can't expect the kind of returns without earning support. Earning support is not there at this point of time.
Since earning expectations have been trimmed down dramatically, can I safely assume that stock markets will correct much more because earnings will not recover in a hurry? The best case estimate is that earnings will now recover only in the second half of this year.
No, while that is true, still when we meet foreign investors, they're saying we get 0% interest rate. So we will be happy with the lower returns in equities. So I think if there were to be a serious change of view on interest rates in the world, then maybe the correction can be deeper, but that's not the current view. Current view is just a switch from a performing country like India to some of the countries where they have all been underweight and which have been very big dogs. It's more a switch of money from in this manner, rather something more fundamental. Do you have to worry about our equity allocation, what we should do with equity? I don't think we are in that kind of situation.
Do you think the market behavior will now get reset? And when I say reset, for the longest time, defensives, pharma, consumer, and some of these 10, 15 halo stocks have dominated markets. But whenever markets will stabilize, do you think a fresh leg of rally will start in industrials and cyclicals, because that's where I think earnings will also start?
Actually, that's what we've been hoping for, but it has not happened. Maybe this reset that happens. But one thing, problem is for the industrials and cyclicals to do, you need a serious pickup in credit growth and capex. We still don't see that in the next 6 months, either credit growth or capex cycle is going to improve substantially. But maybe over a 2-year period, certainly. But over a 6-month period, I think that the day we believe credit growth will pick up and capex will pick up, I think the ownership of or the leadership in the market will change. But we are not seeing it yet at this point of time.
Typically, markets always bottom out when there is an event or there is a trigger. Earnings will not be a trigger. Crude is no longer a trigger. So what could be the next trigger, the next event which markets are anticipating, and if we come on the right side of the event, that will help the market recover and revive?
See, clearly, I think if US were to make more announcements on interest rates, that would certainly work as a trigger, because at this point of time, there is a certain worry that interest rates in US will be hiked either in June or in September.
Is that a real worry? Because it's comical the way Wall Street analysts are changing their estimates on when Fed would move. First it was June, then it was September, then June again, now it's September. September could become December.
No, it is still a worry. Even if it never happens this year, it is something that people know can happen eventually. And if you're going to have zero interest rates permanently, that's a new world. And in the new world, there would be a lot of new thinking we have to learn, because it can't be that zero interest rates have no negative impact. That's how it has been over the last 4 years. So is there going to be some negative impact due to zero interest rates? Maybe, but we don't even know because we don't understand it. And sitting in India, we have a tight monetary policy relatively. I don't think we in India will ever be able to understand the world of zero interest rates.
Okay, so let's talk about your basic portfolio strategy. If you always like to invest when there is outright fear, and I can smell and I can see fear in two groups, IT and metals. Let's talk about both these groups. Is it a good time to be a buyer in IT? Q4 numbers were not inspiring. Management commentary is very lukewarm.
Yeah, clearly, if you see IT, I find it very funny. Each quarter, one company will come and say something negative or positive. And then the market reaction to that quarter's result is as though for the next 3 years, the outlook will remain. One quarter later, they'll give you a different outlook and then the whole sentiment changes. So I've seen that after every quarter result, we get an opportunity in IT.
So are you buyer in IT?
Clearly.
For the longest time, you've been underweight IT.
Yeah, but that, has been, but I think clearly we are entering a period where Indian rupee has done very well, that hopefully there will be some amount of depreciation. Between that and the fact that IT is the cheapest defensive sector in India, I think IT has become a very, very interesting value opportunity at this point of time.
Does it make sense to buy a pharma also? It's expensive, but a stock like Lupin or a Sun Pharma, some of these stocks have corrected 15, 17, even 20% from the recent highs. In December, you were of the view that pharma is a great story, but it does not fit my style of investing because of rich valuations. Is it time to buy into pharma?
There is still no fear in pharma. And, when you see there have been two big global acquisitions which have been announced by two different companies in the world, at a time when you have such big mega acquisitions being considered in the world, there's complete absence of fear in generic pharma. So that militates against value investing. The correction is, if you look at the last 45 days, I was surprised to see, if even today, I think the best performing sector for the year is still pharma.
Lupin, Sun Pharma, they're the best performing
let them
stocks.
at least become some of the stocks, let them at least perform badly year to date, because they have done well over 6 years. From 2008 to 14, each year I think they would have outperformed. So I think let's wait for a period of time where they underperform for slightly longer period of time. Then we can look at the sector, because finally over a long period of time, I think all our healthcare needs keep increasing. So I would say from a structural point of view, over a 10-year period, I don't think the sector can do badly. But I'm waiting for a better entry point.
What has got unnoticed is the way how PSU banks have collapsed in this year. A stock like PNB is down 30% plus. BOB is down about 20%. State Bank of India, similarly down 14-15%. Do you smell and see outright fear in PSU banks?
There is outright fear in PSU.
Are you buying this fear?
One of the checklists that we have is that when we have a leveraged company in fear situation, we don't try to catch a falling knife with the same enthusiasm, because what we have learned from our experience is that in all leveraged companies, you have to be acutely aware of being contrarian, because they can really change things.
So you don't own PSU banks?
It is not that we don't own PSU banks. We do own PSU banks, but we are not willing to take that outright large weight.
What is stopping you? Because rates will come down, economy will pick up, corporate India will have a better balance sheet. It's a matter of maybe a quarter, 2 quarter, 3 quarter, and PSU banks clearly offer you the biggest proxy or the best leverage for when it comes to economic turnaround.
I think the most confident view we have is that rates will come down over a year. So we can play it through PSU banks or regulated power utilities. Regulated power utilities appears to be a much safer way to play. You get lower upside, but you don't have to worry about downside. So that's how we are looking at it from a rates point of view. If you take the NPL situation, we still feel there are steel companies, there are power companies, which all yet have not declared themselves as NPL. So, you know, maybe after this quarter results, and if we feel all the steel companies and power companies which we thought are in trouble have recognized themselves as NPLs in the banking system, maybe this quarter's results could be very well the bottom of the sector. But you know, at this point of time, we are not able to make that call with the same vehemence. It is not that we are negative on PSU banks. We are reasonably neutral towards PSU banks, but we are not yet willing to take that case of a big positive position.
One of the sectors you've liked and you've disliked and you've liked in the past is telecom. For a change, there is visibility. We know how much telecom companies have paid in spectrum, what will be the margin impact, and which way rates are going. Are you a buyer in telecom?
See, the fact is that we are, you know, what I've seen in that sector is there are periodic bouts of fear. In those fear you buy, then there is a period where fear is forgotten. Then at that point of time, if you don't trim, it becomes right now. The good thing is, I'll say at least there's no auction for the near term, except possibly one 2100 megahertz spectrum.
Which is the small part.
Small part. But you know, there are always threat of new entrants. So I would say what we've seen is once a year, there's an opportunity to buy in fear. Now we are in neutral territory with the recent correction. So I would say we are neither in fear nor in any euphoria in the sector. So we are midway at this point of time.
Talking about fear, there is a belief, there is fear, and there is widespread opinion that Indian rural economy has taken a knock. Unseasonal rains, MSP will not go up. In general, land prices are not going up. The gold effect has got reduced dramatically. Is that a real fear?
I think there's a much better contrarian long-term opportunity, because you know that rural consumption has to pick up with a 3-year view. So the question is that you have to time the entry, you have to keep buying, you have to start now, because some of the stocks like two-wheeler stocks, they have underperformed the market 30%.
Yeah, Hero MotoCorp is down 30% this year.
So, you know, you have huge stocks with good quality businesses which have become dogs in this market rally. So, you know, we are looking at it and we have started to look at them. But having said that, what we feel is we have to spread the buying, because we don't know what the bottom will be. But I would say the time to buy has started. The time to complete buying has not yet reached.
We always focus on what you buy. Let's talk about what are you selling. Where are you taking some chips off the table? Where are you peeling off? What are you, subtracting from your portfolio?
See, what I find is that we virtually don't. We have cut our weightage in consumer, cut our weightage in all the quality mid caps which have done well. We've cut our weightage in healthcare over this period. So if you see, these are sectors where frankly we have come out of. And the good thing is the Indian mutual fund investor has actually chosen to invest in the last 1 year after being out of the market for 6 years, even though he's still underinvested. So I would say, luckily the mutual fund investor has given me more opportunity to buy rather than look for what to sell, luckily, because he has been putting good money into the market. So I hope that the mutual fund investor continues to invest in the corrections which will be there this year, because I think the long-term outlook on equities continue to look good.
In general, the numbers have been strong. So what is the situation at ICICI Prudential? How much fresh inflows you've got in this year?
I think it is pretty large. I think it's the highest ever inflow which the industry has ever got outside 2007.
Is that a trend in making for FY16?
I think the trend is certainly going to continue because I think Indian investors are very underinvested financial assets. The way mutual funds luckily at the bottom also collected money means that the investor experience has been good. So I would say that the long-term outlook for new money to come into mutual funds looks very, very good over the next 3 years.
I'll ask you a very basic question, and this is not related to your investment style, but something which our retail audience and some of our viewers would like to understand. If the India story is so strong and if the India story is so vocal, why are markets so volatile?
Markets are volatile because there are buyers and sellers, and markets not being volatile is a bigger problem because then people tend to...
So this is a healthy correction.
It's a very healthy correction. I believe that if you
Nobody likes corrections.
But
why are you calling this correction healthy then?
Because in fact we were, I think most of us in the mutual fund industry were waiting for a correction.
Okay.
So I would say this is a healthy correction because we've got money to invest. We know that Indian investors are under-invested equity. So the correction is absolutely necessary. Otherwise people would have forgotten the 4-letter word called risk. I was more worried about people forgetting risk. Luckily this correction actually will bring the risk element and people will be more circumspect when they in the returns that they expect.
What should be a reasonable return expectation from here for next 3 years?
It has been between 10 and 18% is what I would say per annum is the kind of...
Can we get that with the kind of earnings we are reporting?
See, I think the earnings for the next 6 months is no reflection of the earnings for the next 3 years. In my opinion, a year down the line, there has to be a capex cycle. There has to be a credit growth cycle. And once you have a capex and a credit growth cycle, earnings should improve. Having said that, I must agree that there are areas like telecom, mining. In all these areas, a lot of the profits are now accruing to the government. So due to that, what will happen? The government finances will be in a far better shape than they were in the earlier cycle. Corporates will make lesser money in these areas. So you might have to give a higher discounting because we think even interest rates will come down. So when you had interest rates much higher, like 2 years back, there was a certain valuation that you expected from equities. If interest rates will be much lower 2 years down the line, I think people should prepare for a higher valuation.
The Prime Minister and his core theme has got some, themes. Digital India, Made in India, Defense, Railways. These are mega trends in making. Are you betting on anything specific here when it comes to a mega trend?
See, I think, what happened in many of these things, euphoria set in. So when euphoria sets in, our research process says, let's wait for things for the euphoria to settle. I think we are seeing the beginning of euphoria settling. So maybe the real investment opportunity will come in the next 3 to 6 months when euphoria goes away, reality strikes, and we get the right stocks belonging to these themes at the right prices.
If I take the clock back, I think it was October 2013, your view was that buy mid-cap stocks aggressively because that's where I think that was the honeypot and you were treasure hunting there. What is your take on the current valuations for mid-cap stocks? Because if I look at the Sensex P versus the P for the mid-cap index, strange, but the mid-cap index for the mid-cap P is actually higher.
Clearly, as a theme, we like large caps a lot, but mid caps we have to go stock specific. We are seeing many of the sectors where large cap P's are very low, the mid cap stocks are even cheaper. So we are actually looking at mid cap stocks belonging to those sectors which are trading very cheap in large cap itself, and those are the stocks we are looking at.
Can you give me an example without getting into a stock? But how are you thinking? How are you investing? Where are you shopping?
So if you look at sectors like tires, shippings. They're all stocks where you have sub 10 PEs and in some cases much below book. You're at a time when the large cap index trades at closer to 2.8 or 2.9 times book. You have a number of healthy quality balance sheet companies which are trading below book in some of these sectors.
What happens to the quality end of the market? It will not die. The Bosches of the world, some of the Page Industries or perhaps the iShares. That's a vibrant space. Those companies are still growing. Some of them are great companies. What happens there now?
They can go through what is called as a long time correction. I'm told this word called time correction globally they don't use, but in India we're used to this word. So maybe there'll be a long time correction. But I have seen that, after some period of time when you have a long time correction, people say, let's sell the stock and move into something else. So I believe quality mid-caps have absolutely no value compared to the value of debt today. I think debt mutual funds should outperform some of the quality mid-caps clearly over the next 1 to 2 years.
Why should debt outperform quality mid-cap stocks in the short term or perhaps in the medium term?
Because 60 PE can come down to 50 PE and 50 PE can come down to 40 PE. So if a stock moves from 60 PE to 50 PE, it can give you a reasonable, either a no return, whereas debt in India still is closer to much better returns than what you can get.
Is there money to be made in the debt side of the market?
Clearly, I think debt is a very interesting product for the next 2 to 3 years. And I believe that India cannot have such high interest rates. We need much lower interest rates. I do agree CPI is high. But you look at wholesale price index. Can you think of a situation where wholesale price index is minus 2.3% and your bank base rate is 9.8% today? So you're talking about a real rate against WPI of 12.1%. I believe Indian industry and Indian growth cannot pick up with real rates against WPI of 12%.
Naren, historically you've been very vocal about the funds you've liked in the past. 2013 it was the small cap fund. You've talked about volatile, arbitrage fund also in the past. So at the current juncture, this is April 2015, if someone has to pick and choose one scheme out of the ICICI Prudential AMC umbrella, which are your top 3 schemes?
See, we have created products, which can take cash also as a call, like the dynamic plan, balanced advantage fund. Those are my most favored funds at this point of time, because I think market is headed for a period where you'll have volatility, and if you within capitalization we are totally for select large cap, because we think that large caps are much cheaper than mid caps at this point of time.
So go for the large cap fund, not for the mid cap fund.
Mid cap is an SIP fund at this point of time, given that mid caps have done very, very well in the last 2 years.
Closing comments, what's your big call?
I think the big call is, basically our big job is over the course of the next 2 years to increase the percentage of financial assets invested in mutual funds. In my opinion, financial assets invested in mutual funds generate far higher return on equity to the country and to their investors. So I think that's going to be the big job for us. But we have to moderate return expectations in equity, because people have very high return expectations when they enter equity. So we have to do that by talking about lower returns. That's the challenge.
And this quick move from 9,000 to 8,300, it's a sizable correction of about 5% plus on the Nifty, 10% plus on the mid-cap index. One should not get worried.
No, not at all. I think this was the first time where for 18 months we didn't have even we've still not had a 10% correction. So I think basically we have created a situation where even globally, where there are no meaningful corrections. I think that's very wrong, because people do a lot of stupid things when they don't see a correction for a long period of time. So if there is a meaningful correction, I think the market will be very healthy. Investors will recognize the word risk, which benefits them. I don't want a 2007 kind of situation where people forget the word risk. The word risk is now back. So that's very good for all of us.
Yes, Naren, appreciate your time. Lovely to have you back. That's it on this edition of Market Makers. Thank you for watching the show.
Find us on Facebook at facebook.com/ETNow, and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.